Pleased to meet you all. I'm Damien. I'm a partner at Blockwall. I'm running the French office, which consists of only me. But so far, it's been going great. And today, I've brought some of the brightest mind of the TradFi X Web3 world on stage. And I would like to introduce this panel with a few words on my end. The first sentence that brought to my mind, the first sentence which came to my mind when discussing the world of finance was, what a year for crypto. I think, it hasn't gone unnoticed, but of course, Bitcoin has made quite a headline recently, while reaching, almost the 100K threshold mark in terms of price. That has largely been driven, of course, by the approval of Bitcoin spot ETFs that we've all noticed, recently, with influx in the north of 33 billion in the past few months. Of course, the second biggest news of the year for the crypto ecosystem might as well be the re-election of Donald Trump, which, you might like it or not, is definitely going to bring on board a lot of crypto people to his administration, or crypto positive people to his administration. We've seen quite a move in the regulatory space, and we are sure that this push in the US is definitely going to make the space even more interesting for the crypto environment. Now, of course, the biggest question that remains is how far are we along the road of mainstream adoption for crypto within the financial world? And who else best to talk about it than people that are actively working in this field? Hence why I welcome today my three esteemed panelists. We have Ambre, who is the founder of Kaiko, and I think we got a hint about it thanks to Yvon on the last panel. Valerio, who is the co-head of digital assets and DLT at Banca Sella, and Michael, who is the founder of Trenched. So I'm not going to sit, it's going to be a bit more comfortable for me. I would like maybe first to introduce yourself, guys, by asking you one question, on which you can also jump and introduce what you do in your daily life at your companies. As I said, while Bitcoin is making headlines now, we're still very much in the process of seeing adoption from crypto within the traditional financial space. And this is what this panel is mostly about today. So if in one sentence, you could describe how you personally describe the most exciting feature of Web3 in finance today, and your vision about that future while introducing yourself, that would be lovely. Ambre, you want to start?
Yes. Sure. Hello, my name is Ambre. I'm the CEO of Kaiko, and Kaiko is a company that provides cryptocurrency market data. We're only working with regulated institutions, regulator themselves, or crypto companies that are providing financial services on crypto assets. Now, when it comes to kind of the intersection of finance and crypto, two things I find very interesting and that are leading to the same path. On one side, we're starting to see the onboarding of cryptocurrency as an asset class wrapped into traditional financial wrappers, and this is the ETFs, for example. We're making crypto accessible in a fully regulated TradFi way, and I like to compare that to like the baby bath before jumping in the big pool. What I see, you asked about the vision, what I would call here the big pool is doing the opposite, meaning bringing traditional finance on blockchain rails. And that would mean using blockchain as an underlying infrastructure in order to power traditional financial applications entirely on-chain without needing to use or hold or refer to crypto as we know them today. But at least today, we democratized crypto by offering investment vehicles in a regulated way, which I think is a big, big leap forward already.
Definitely a good first step, yeah. Valerio?
Hi, everyone. I'm Valerio. I work for Banca Sella, whom I recognize most of you might not be very familiar with. Banca Sella is a mid-tier Italian bank very diversified in terms of financial sectors it covers, mostly active in retail, commercial banking, also very strong in private banking, and has a very, let's say, unusual for its size footprint in payments, retail payments. And I take care of digital assets and DLT since almost 4 years now. Completely agree with Ambre on this, especially on the second part of what you said. This is at least the part that I'm covering the most, and the one that we as a bank see as, let's say, the part with the longest tail and with the longest kind of effect that it can have on traditional finance. Of course, I'm referring to asset tokenization and the way we can bring non-blockchain native assets to the blockchain for efficiencies, for both in terms of costs and in terms of time. The thing I can say is that this excites me a lot as a vision. It also scares me a bit because the time that is required to do this and the effort, the collective effort from the banking sectors in Europe, in different countries, will be massive. It is starting right now, and I will cover this in detail, I think, in the next question. It's very different in terms of approach between different European countries. So you have banks that are more advanced, banks that are less advanced, regulators which are more advanced and less advanced. So this creates kind of problematic starting phase, let's say. So definitely the aspect that excites me a lot, but that it will also require a bit of time and effort from all sides.
We'll definitely dive into this specific topic because, I mean, as you said, it's key, right, for adoption. Michael?
Hi, I'm Michael, co-founder at Tranched. Tranched is a blockchain-based solution that allows to automate complex asset-based lending transactions. So our clients are originators, fintech lenders, non-banks that need to find capital, typically through large institutions, banks, asset managers, or large family offices. And those asset-backed transactions are quite complex to set up, and so our solution allows them to be automated, simplified, so we facilitate access for investors to those private asset-based lending transactions. We talk about securitization, asset-backed lending, etc. What we see as a change over the last few quarters is the reception of tools such as Tranche, where investors don't really ask about the underlying technology, it's blockchain, but facilitates and solves current needs. And what we see, there's a lot less friction in terms of how we present the solution, and I think that kind of evolution in the mindsets of investors and all the parties we work with is a massive change. It's not going to happen overnight, but this kind of change of paradigm is clearly there, as we see more and more mainstream asset classes being disrupted by the technology itself, and people see that if you offer a superior tool, then you'll have a good response and few questions asked about the underlying technology.
I think we have a good progression in the panel, and that's why I want to zoom back to you, Valerio, because you kind of represent the traditional bank ecosystem in this panel. We've started discussing that already, but how do you specifically see the integration of crypto into traditional finance system evolving as of now? I mean, I think it's the gradual steps, right, that you have to take, but I'd be super interested to understanding the journey, right, from Banca Sella, for example, in this space.
Yeah, sure. So, as I said, the vision is there towards asset tokenization and the like, but since this is going to take a while to happen, the present, at least in terms of offer we can have towards customers, is mainly about cryptocurrencies, and so the basic service we are aiming to offer and that we are building since like a couple of years ago is crypto custody. Which is we see as a step zero of the whole strategy we want to have, because it also cannot be done without learning and development programs for a lot of different functions in the bank. Yep. That is a very traditional bank. So to just have all the control functions and people aligned to understand what a blockchain is, how it works, and how doing custody is different from any other kind of asset class they know, takes a while, and also takes a while to update the technology, which was also mentioned in the panel before. So that's kind of the step zero we're undertaking right now. And so there's one angle we're seeing as crypto in traditional finance, that is, what's the offer we can have towards customers of different kinds, but us towards customers. Then there's another angle, which is as important to us as the first one, which is how we can use the blockchain to have efficiencies in the, let's say, traditional way of offering services to the market, which is which means actually looking at the traditional finance landscape and seeing the most inefficient parts of it and trying to see whether blockchain can actually help there or not. This is actually the way we saw cross-border payments taking, let's say, the center stage of many talks with international banks in the last at least 2 years, because cross-border payments outside the SEPA area are extremely inefficient from a cost and time perspective. So it's obvious that the blockchain can help there. Yeah. So these are the two angles we're looking at. One is also internal efficiencies with blockchain. We experimented, for instance, with the escrow accounts, blockchain-based between two parties, because the inefficiencies also coming from within the bank are massive if you think about traditional banking. So there's a lot that can be tackled, let's say, even just from the second part.
Yeah, when we have actually a panel on payments this afternoon as well. So that, because this is probably blockchain's proven best use case also for institutional clients at the moment. I would just like to bounce back on that question slightly, saying, what was the main driver of this development of new offerings and starting with custody? From what I understand, was it demand? Was it like a vision from the bank? What's the main driver?
I would say 70% vision from the bank and 30% client demand. That's also kind of in the DNA of the bank I represent here now, because it's first of all, it's a privately owned bank, so it's owned by a family, and the family itself is very has a pioneeristic approach with like innovative waves. It's kind of easier, I think, if you're an entrepreneur, to understand that maybe some big changes arriving in 10-15 years, that not only you'd better be ready, but maybe you have some market advantage if you start understanding what it's about now. But client demand also was there, of course, depending on the crypto waves of 21 and right now. But for a bank, it also means to develop a vision to tell something to customers, because then, if even like non-crypto natives listen to the news and understand that there's something called Bitcoin, they go to the bank to understand what they can do about it, and the bank has to have an answer.
Obviously. Oh, I'm turning to you now, because I think the way I've seen Kaiko in the past is more of an enabler for traditional finance to really be able to adopt that kind of solutions. And I know you've been in the field for a long time with Kaiko, so you've emphasized to me when we discussed it the importance of building data infrastructure to enabling broader TradFi adoption of crypto products. Would you say that this vision is realizing today?
Absolutely. I mean, the more we're seeing regulated TradFi investment products, the more you need reliable market data infrastructure. And I'll give an example. ETFs are based on a benchmark, right? There is a benchmark provider to an ETF. There is a benchmark provider to a derivatives product for settlement purposes. In Europe, we have ETPs. There's listed ETPs. They need to rely on either a benchmark provider or an index provider. And you need those benchmark and index providers to be regulated. There is a very big framework that has nothing to do with crypto called BMR, Benchmark Regulation. It's a European Market Authority benchmark that regulates data providers as long as they provide data that will have a financial impact. And so whether it's custody, for example, so we work with custodians because they use our our rates to say, okay, what is the dollar counter value of those crypto assets that I have under my custody so that I can do my billing. And let's assume it's a monthly dollar-based billing and you have so many Bitcoin under custody. You cannot just pick the highest price of Bitcoin during the month and bill your client, right? You need a kind of independent third party to provide those market price reference points for institutional applications. So market data in TradFi is a $40 billion industry. I mean, anybody working in a bank, regulator, asset manager, hedge fund, everybody uses data day in, day out. In crypto, there's been a lot of data, but it's highly fragmented. You have hundreds of different venues for trading cryptocurrencies. Obviously, I'm talking about financial market data. What is the price of Bitcoin, of Ether, of any other altcoin? And so the price of those assets are generated where the trading activity takes place, which is either centralized cryptocurrency exchanges or DEXs, decentralized exchanges. The technical skill in order to get data for DEX activity is relatively high. I mean, it means running a node. It means being able to read the data within the blocks in real time, contextualize this data in order for Kaiko to tell a client there was this trade on Uniswap at that time during that block for that price. It takes some skills. And so all of that market data infrastructure in crypto has been relatively immature and very fragmented. And Kaiko has kind of taken the route of bringing a TradFi standard into crypto. So we're audited, regulated under BMR. We're completely global, and we work with about 150 regulated clients. Yeah, I mean, I think when we talk about adoption, it goes both ways, right? And that's what you essentially highlighted, right? I mean, TradFi has to converge and adopt those products, but those products also have to standardize at some point to make it happen. Valerio, I have a kind of follow-up question on all of that, infrastructure foundation of the adoption. Is what groundwork you think is still needed for institutions like yours to truly embrace crypto in a compliant and sustainable way?
First of all, part of the burden of this is on the banks. Part of the burden of this is on the regulators, which, as I said before, make a very fragmented landscape right now in Europe, because some national regulators are way more, let's say, crypto-friendly than others. France, for instance, is very strong, I think, from an Italian perspective, is very promoting the technological advancements also for traditional finance. So they're bringing traditional banks into the conversation actively. While coming from Italy instead, with Bank of Italy, the relationship is very, it has evolved throughout the years. But for now, it means that the way we can be compliant in offering our services is done by minimizing the number of services that we can offer, of course. Because as the approach is to understand gradually how the blockchain can change traditional finance and the like, it means that it's extremely safety-oriented, the approach from Bank of Italy. And this, of course, will evolve. It's not like has to evolve. Will evolve once MiCA is in place, once there's a European level playing field, and so even the moral suasion that the national regulator can have will go will be less important than before. And we've seen from different national regulators, like even BaFin, for instance, the willingness to understand a lot about this world in as a few time as a small time possible, because banks are trying to offering services in this field. So this is on the part of the regulator, which is important anyway, because otherwise you want to offer services you are not able to.
Yep.
On the banks, there's a lot of convergence between the capabilities and knowledge, let's say, of the traditional finance experts of risk management, compliance, and the like, and the new world of blockchain. Once we started, of course, like getting through the ins and outs of custody. We did also like stable coins test and the like, and we received a lot of very important feedbacks and challenges coming from traditional finance people that were getting to understand the ins and outs of the technology. So this, of course, investing a lot on the traditional control functions of a bank is crucial, of course, to ensure the future of services for banks and compliance.
Yeah. Michael, I'm finally turning to you because you're a builder in the space, and I think you're kind of enabling the next steps as well, right, when it comes to more complex products. And I'd like to explore that with you. Could you highlight your perspective on how blockchain creates opportunities for rethinking traditional asset classes?
Sure. I think to do that, I'd like to take some tangible examples to make it more palatable to the audience. Starting with the theme that was quite prevalent earlier in this year with money market funds, we saw a big wave of projects that were tokenizing UCITS, so kind of traditional money market funds. And as they did that, we saw the use cases coming, which were giving access to very short-term treasury products to retail and small businesses, where this was typically available for larger institutions. And we see a rapid adoption of that because this product, thanks to blockchain, was a superior experience, was more practical to use for those end customers. And so that's a tangible example that, as it's being built, shows and demonstrates the superior technology of blockchain. Now, if you turn to what kind of currently the flavor of the market is private credits. So with the rate hike, people got quite excited about private credits, and with the kind of the rates softening now, people want to maintain higher yields, and so they're really looking at that. And Apollo reported a couple of weeks ago that they expect the private credit market to reach a 40 trillion size in the next few years. So it's a massive opportunity. But when you think about private credit, it's a very appealing asset class for all type of investors because you can have a duration-adjusted investment. It enjoys a premium to public markets, typically 100 to 400 basis points. So it's a substantial uplift for a similar risk profile. That said, the issue today is that it happens to be a walled garden for large institutions because it's quite hard to tackle. It's hard to structure and to enter. And so a lot of investors would rely on third-party specialists to structure the deals and would give away 50 to 70% of the premium they could have grasped if they were investing directly in the asset class. So when you think of structured credit, private credit, it's extremely programmatic. It's a bunch of rules that have to be applied to a transaction in terms of deciding what assets are eligible, what are the priority of payments, the waterfall that everyone has to take care of in very many investment asset classes. And so all of that screams smart contracts. So using blockchain to structure the deals and automate them makes them a lot simpler to access, a lot more robust, and basically gives, we believe it's kind of 5 to 10x potential investor pool that could access this market in the next few years. And so that's a very tangible use case. And we see that, as I was saying earlier, that blockchain is a means to an end. It's not, a feature that people get excited about. It's just a way to do things better, to give better access to those investment opportunities to investors, and in turn give better liquidity opportunities for those originators, so the borrowers, which are themselves serving the real economy. So it's creating this virtuous circle, which is very powerful and exciting.
Yeah, I think many Web3 projects actually face the challenge also of integrating their solutions, right, with the traditional financial system, or just like legacy, I would call it, IT systems. And it's a question that I'm directing to you all. It's like, in your opinion, how important do you think it is to actually design solutions that work within current workflow versus believing that everything will move on chain and that you won't technically need that? You want to start?
Yeah. So prior to Kaiko, I spent 10 years doing equity derivatives. And it was right when I started reading about Ethereum and smart contracts I was never really a believer that we would disintermediate everything and kind of, kill the banks and the central banks, and we wouldn't need any more centralization ever. I don't believe in that at all. However, I do believe that we can take it step by step and start disintermediating things that are kind of the low-hanging fruits. And what I have in mind here is the middle office stuff, right? So you need the bank, the balance sheet, the regulation. You need somebody to actually find the client, structure the product, sell the product, right? But then once the product is kind of issued on the primary market, the secondary life cycle of an instrument and then the settlement, and I'm just going to keep on the example of derivatives. If you think of a basic call option on any kind of equity, it's literally a subtraction, right, between a strike price and the price the day of the maturity of the contract. So you could write the equity derivative contract into code, literally. I mean, you could smart contractize, launch it on a blockchain, and then on the day of the maturity of your smart contractized equity derivative, what you need is a market data input feeding the contract with the price of the asset at maturity. Once the contract has that and consumes that input, it can very easily know, okay, does the option expires worthless? Is there something to pay? I'm going to do a subtraction, whatever the formula is, to calculate the payout, and then I can instantly settle on-chain. And that's something that I find very interesting. Everybody talks about tokenization of assets. I don't think this is the big problem here. I think we should not focus on tokenizing assets. I think we should talk about tokenizing contracts. Why? 90% of the capital markets industry today is cash settled. People care about getting the upside performance in dollars paid to their account on time. That's what they care about, right? Unfortunately, honestly, I'm a big believer in crypto, and I've had so many people recently from TradFi call me, say, how can I get into crypto? It's time now. And I'm like, well, go and buy Bitcoin and store it yourself. They're like, no, I don't care, I'll get an ETF thing. And actually, that's the reality, right? And if we start tokenizing everything, not everybody's going to walk around with like a ledger key with their Apple securities around their neck, right? They just want the price performance of the asset. So we need to think about kind of the bottleneck where we have inefficiencies here is the kind of calculation, leveraging middle office, back office, all of those kind of intermediaries that honestly could be disintermediated, and the delivery versus payment settlement layer. I really think this is where there is a low-hanging fruit for TradFi, and that could be the first step towards a more on-chain capital markets industry before needing to tokenize everything so that then we can contract on stuff.
Valérie, you want to add on that?
Yeah, I would say that coming from my perspective, going step by step is kind of a mandatory approach. If the question was more on, is it good or does it make sense to do kind of a leap forward now and experimenting and actually do stuff that is very technologically advanced, that would be the end game. But for us, let's say for the banking environment, at least in Italy, it is mandatory to do all the small steps because, first of all, not everyone inside the bank is on the same page, and not every bank is on the same page. So even in the Italian environment, we have many extremely big banks which are totally in denial of the fact that the blockchain might or will impact traditional finance at some point in time. Yeah. Which means that since the majority of the benefits that we're talking right now are systemic, because it means that if Banca Sella does something on the blockchain, it's like it's a mid-tier bank and it's on its own, while if we reach kind of a system of banks that uses the blockchain, for instance, to do delivery versus payment, or it has a number of stable coins that it uses on the blockchain to do settlements, interbank, for instance, that only happens is if we do all the very small steps, which are understanding the blockchain, what can you do about it, so experimenting together and the like. I personally would like to go way faster than this. But it's a big trade-off between the very much added benefit at the end of the game and the kind of badge that you can have on yours that says I did it, next. And it makes little sense right now, I think, to proceed that way.
Yeah. Michael, I think I know your answer, but...
Yeah, so we have a very institutional approach when it comes to deploying our solution. And 99% of the liquidity to finance the real economy is off-chain. The moment you go to see an institutional investor and tell him, well, everything is going to be fine, just open a wallet, then the discussion for traditional finance, debt financing, this discussion gets quite cold quite quickly. Debt investors are managing their downside risk massively, and if you offer a solution that introduces new risks, then it creates a lot of friction. Our conviction, to Amber's point, is that we are tackling, and I think successful projects are tackling a specific problem that is not solved in Web2 TradFi. You apply a better technology to it, demonstrate the value of it, and then people adopt it, and that's exactly how you bring this the technology systemically in the space. And as you do that, then you develop new use cases, and you can bring new features that are ready in your technology, but you can't really deploy because of regulatory issues, custody topics, investors' readiness, etc. And those use cases will come to life as the technology is deployed.
Yeah, I think I would like to touch again on the liquidity topic, which is something that Trench it's definitely enhancing. How do you see that benefit being widely adopted in the private debt market? I mean, what does this mean for investors, essentially?
Yeah, so again, going back to this kind of relatively large transactions, multi-year investment horizon, typically these are invested in to be held. So if you think of a pension fund that needs to match their liability with investments that have the right duration, etc., they are happy to be invested in the long run. That said, what we already see in the early use cases we've been deploying is that some of these investors would be benefiting from having a liquidity option, either to deploy their investments internally, which is quite clunky and cumbersome today, because you literally have to write a piece of paper, sign them, match the transfer so that you don't have to do complex calculations. With a blockchain and ledger-based technology, you can do all of that in a much more automated way. And so very soon we'll see investors looking at kind of illiquid, multi-year investments in a more dynamic way, and will be able to enter those deals without necessarily thinking of having to hold them if that's their strategy. And we see already use cases where investors decided to go into a deal which happened to be potentially smaller than what they would have wanted to do initially, but because there was no friction to enter the deal, everything was seamless, they decided to go for it. So that's what I was referring to earlier, is like increasing the potential market for those investors who don't really look at these investment opportunities because the barriers to entry are too high. Reducing that will bring more investors and therefore will enhance liquidity. Generally speaking, I don't think that in the next 2-3 years you'll trade private debt positions as if they were public, because that's not what investors are looking for. But we will definitely see a reduction in friction and therefore more capital plowing in the vertical. Very interesting.
So as we digitize more complex financial products like you're trying to do and are already doing actually, and this is a question for all, but what are the risks we should be watching for? Whether it's operational, regulatory, or reputational, what's your take on the risk side of things? Amber, if you want to...
I feel that there's so many aspects to risk. Yeah. I can talk about data-related stuff, liquidity, fragmentation, understanding what's going on DeFi, having visibility. Obviously, I'm selling my own stuff here, but getting the right data, giving you visibility on what happens on-chain versus what happens off-chain. You can do good risk management of tokens by having access to on-chain data, because the on-chain world is kind of automated from an execution standpoint, from a trigger liquidation standpoint. You can generate very interesting alpha on, okay, what kind of signals can I get from DeFi? Price signals I'm talking, and liquidity, squeeze, all of these things happen on-chain before they actually happen off-chain. So from a risk management standpoint, getting your right data is good. Now, I don't know if you were talking about the industry's risk.
Well, no, I mean, of course, I mean, when I talk about risk, is like what challenges are implied by tokenizing or even like digitizing more complex financial products, such as what Michael is doing with Trench, for example.
Well, maybe I can pick that up. I think where we start with is we actually, with a fully immutable, traceable, transparent tech stack, you suddenly reduce a lot of risks that were inherent to the asset class, because in private debt, everything is kind of dislocated, reporting, investor information, all of that is not linked to the underlying assets. So with a solution that's immutable, traceable, you reduce that risk massively. I think the North Star should be to maintain the other kind of standards when it comes to the risks you mentioned in terms of KYC, AML, regulatory risk. So making sure that the framework you operate in, the deal structures you set up are compliant, well structured, etc. So the way we think about it is taking what's working in TradFi well in terms of regulatory environment, structure frameworks, and add the tech layer on top to improve it. So rather than we saw in the prior cycle a few years ago some projects that were applying securitization, asset-backed lending principles to completely poorly structured and poorly assessed investment opportunities, and that didn't work. So what I'm saying is let's keep what's working in TradFi and improve it with our solutions collectively, and that should work.
Valerio, what is the most identified risk at bank level?
So I would say all the things that have been said right now are true also for us, of course. There's an added element, which I think is reputational risk from a banking perspective, in being kind of the first movers in this field. At least that's the one that is most perceived at a very high level in the bank. So the top manager of the bank says, this is a new technology, we have to move forward, we have to understand, but we have to be very careful, because if something happens in this world that we're not understanding or that we're not able to justify at some point because you don't understand the ins and outs of the technology, that's a risk. So, and this is shared by many banks, I think. How to avoid that risk, or let's say to tackle that risk properly, to me is to get a lot of crypto people inside the bank so that they understand the technology, they know how it works, and they can train and educate the other people at the bank so that at least the bank knows what it's doing when it tackles, let's say, the whole crypto and blockchain-enabled market. That's a very important step, because also in the conversation with the regulators, both like at a national and an international level, it helps a lot, because we're all kind of growing together in terms of, okay, there's a bunch of startups doing things, what do we do now? That's kind of the approach that Bank of Italy has many of the times. And if they know that they can navigate this complex world with the help of a traditional bank, that's easier also for us.
Yeah. Thank you.